Today we have a really amazing guest, and I think he's going to entertain us too, which is more than previous episodes because they're kind of boring. So this one I have a feeling is going to be exciting. Dave Seymour, he's CEO of Freedom Ventures Investments, but you probably recognize him from the big television screen on A&E hit television show Flipping Boston.
We bring a massive service. Think about this for a second, brother. We bring a massive service to the community because you don't have to go out and get our 50 plus years of experience to be successful in commercial real estate. All you have to do is just hitch your wagon, baby. Hitch it on, come for the ride. We got all the bases covered. You know, I make it simple, but you got to educate them and bring them up the gradient first. But that's a great service that we provide them. I don't have any reservations about that ever. It's just strong.
Welcome to the Investor Financing Podcast, where we interview real estate investors and lenders so you can learn all the secrets to getting your projects funded and scale your portfolio. And now, your host, Beau Eckstein.
Hello, and welcome to another episode of the Investor Financing Podcast. Today we have a really amazing guest, and I think he's going to entertain us too, which is more than previous episodes because they're kind of boring. So this one I have a feeling is going to be exciting. Dave Seymour, he's CEO of Freedom Ventures Investments, but you probably recognize him from the big television screen on A&E hit television show Flipping Boston, and that's how I recalled you. And yes, I love the show. And we were laughing before we just went on air is that he didn't know that I did a stint on HGTV. And I am also a paid actor, but not as famous as you. But it's a fun experience, and we were laughing about how fun reality TV is. But
it's a blast.
So we're going to take a deep dive and just, you have an interesting background because you started as a firefighter and paramedic, and I want to know like how you got into real estate from there and like how it led you to where you're at today.
Yeah, sure. Thanks, Beau. Thanks for having me on this party too. It's fun. And I didn't know that you had an HGTV show. You know, it's interesting. There's reality TV, and then there's just bend the crap out of reality TV, right? They just bend it, and it's got no, it doesn't really have a lot of substantial business acumen behind it. So, watcher beware. Just because it looks easy on TV doesn't mean it's easy in the real world. I'm asked that question every time. How do you get from a firefighter to national recognition to be managing, $100 million private equity fund in such a short period of time? And my journey's only been about 12 years, really. But I'll dial it back. Look, I'm an immigrant to the States. I came over from England back in 1986. I was a young kid in his 20s, following the woman of my dreams, who was an American citizen. And with that, I bought my W-2 mentality, right? I was from a working class background. I always say today in finance, I'm a blue collar guy with a blue collar attitude in a white collar world. Like I don't put up with the BS and the airs and graces of your Harvards and your Yale alumni. You know what I mean? I don't care. I got scars, baby. But I bought that working class mentality, and it hurt me, and it hurt me bad. I spent more than I earned because I was a naturalized citizen of America as part of our Constitution now, not only pursuit of, happiness, but also the pursuit of a lot of debt for some reason, unsecured debt, unappreciated debt. And, I was in a rough place. 2007, I was losing my home, pre-foreclosure. I'd refinanced it 4 times in 18 months, something ridiculous like that, because everybody said real estate never goes down. And we know what happened in 2008, right? Yeah, how you doing? So I found myself in a pretty dark place, to be honest with you, Beau. I sitting in my pickup truck, screaming and shouting at my God, like, what the heck, man? I did everything I was supposed to do. I don't lie, don't cheat, don't steal. What's going on? Help me out! Crying like a baby. And commercial came on the radio. Teach me foreclosure, a free 1.5 hour seminar coming to your neck of the woods. And I'm like, all right, God, I'm listening. And I put it in a humorous, presentation. But the truth of the matter is, it was a tough time for me. It was dark. There was a lot of people got incredibly hurt. 2000 and late 7 through to 10. And I saw it as an opportunity. Out of every crisis has created some kind of opportunity, right? You just got to identify it. So anyway, I started as a student, man. I went to a seminar. My wife, Mary Beth, became my first private lender. She put my education on her credit cards because I had a FICO score of 2 back then, maybe 3 on a good day, right? And I started learning. And I'd always had an affinity for sticks and bricks. I had a small construction company on my days off from the fire department. And, it was funny. I was a business owner. And I don't know if any of your listeners resonate with this, but I was that business owner who was always the last one to get paid, right? Everybody else got paid. And if there was anything left at the end of the week or end of the month, I'd get a little taster. So, there wasn't a lot of financial independence. But, in my years of construction, I'd be working on a house or a deck or whatever we would do in a kitchen. And on occasion, these investors would come through and their clothes would be cleaner. Their smiles would be wider. Their car was nicer. They didn't have any mud on their shoes. They weren't sweating. Their iced coffee wasn't freezing in the winter in Boston. And I'm like, what are they doing, And that was it, man. The seed was sowed, and I just went for it. My first transaction was a wholesale transaction. I wholesaled a bank-owned property in 2008, made $5,000. And I'm like, oh my, is this legal? Like, part of me was like, I came out of the attorney's office waiting for the cops to show up and take me away. It felt wrong. It was a property I never owned, right? Anyway, that just put gasoline on the fire, and I just kept going and going and going. And the people that I learned from in the education space actually tapped me on the shoulder and they said, dude, you're doing what you invested to do. And I'm like, doesn't everybody? They said, no, a small percentage of people actually succeed, but you're succeeding and doing it. You should teach it. I'm like, are you kidding me? My house was in foreclosure last week. Now this week I'm going to stand on a stage and talk about financial independence and freedoms. They said, no, don't lie. Just, report the success of the people who have mentored you. And that made sense to me. And it put me in a new realm. Like my network changed dramatically. And because of that, so did my net worth. Found myself with some of the best info marketers in the world. And I mean that, in the world. Found myself sharing stages with Tony Robbins and Pitbull and Damon John from Shark Tank. And, my influence has changed dramatically. And, it just started from there, man. And I just kept on going and grinding it out. And, today's a different story altogether. I look to my left and my right, and all around me is, positive energy, like in motion rather than complaining. Like, the guy or the girl, you always say to them, how you doing? And they go, same old, mm-hmm. Right? How's it going, Bob? Another day, another dollar. You know what I mean? They just ooze negativity. There's no creativity in them. They're just not in my life today. So I made some conscious decisions to work on myself, work on my business, and head down, just go. But it's like we said before we got on air here. It's, it doesn't feel like work. If it's resistant, if it's not pleasurable, I'm blessed that I choose not to do it. So anyway, that's how I started. Next question, please, young man.
That's very good. Actually, I know you think I'm young, but I'm actually pretty old. I'm 40.
No, you're not.
I'm 43. I look like I'm 25, but I don't know.
How do you do that? How is that? Is it lotion or something? Is that what it is? A good face
I don't know. It's genetics, I think. I have the light on me right now, so my skin looks really clean. I don't have any, bags under my eyes. But actually, the real reason is because I didn't get married till I was 42. So I think I didn't age. Okay. Right. And then once you get married, you got to deal with more things, and you got to have responsibilities and
got it.
And I don't have
that's why I look like I'm 80, because I've been married 3 times. That's probably what it is, huh? Thank you.
No, that's the difference. I don't have any children yet either. So I'm gonna be an old dad, but that's okay. That's okay.
I'm an old dad. It's beautiful. I got an 8-year-old and a 9-year-old. A 9-year-old and an 11-year-old and a 26-year-old. So I got game.
Oh, your child's about my wife's age. My wife, no, she's 30. She just turned 30. So we're 13 and a half years apart. But But anyways, if you're going to get married later in life and you want children, you probably have to marry a little bit younger. So.
A little bit younger, and you also better have a pretty good capital stack going into the transaction as well.
Yeah, that's true.
I always say to people, look at my wife and tell me I'm not a good closer. You know what I mean? That's how I.
Well, yeah, you got to have some closing skills, and early on in our careers, you got to negotiate, right? That's how you get being a deal architect and finding these deals. And now more than ever, I mean, back in 2008, you could cherry pick deals, but it's a lot different now. And it's harder to find deals. And people are like, now I'm hearing from the newbies, and they're like, well, I just gotta, what do I do? And I'm like, well, you got to be really good at finding and uncovering deals. Cause once you find a good deal, you just tie it up and then you either assign it or, wholesale it or flip it or right. And so people need to realize that's like the big thing, right? Like finding the good deal and then the money comes somehow. So
it's the people right now who are shopping in the MLS are the ones who are getting hurt. It's just ridiculous what happened with the residential marketplace. That's why we pivoted right away from it. I looked at it. I was in a hard money lending business, similar to some of your history. Mm-hmm. I had a great hard money lending company. It was churning and burning, about 18 million in the pipe, line of credit. Everything was great. And Wall Street said, we don't want your non-QM loans anymore, and you're out of business. But, being just looking at the landscape of the residential marketplace, it's like, man, everybody was a genius real estate investor in 2004, 5, 6, and 7, right? You buy a house on Friday, it'd be worth more money on Monday, But people have forgotten, like that their memories for some reason have softened, since 2008, and it feels like it was only yesterday, for me. I got 10 years on you. I'm 54, but I think we both still remember, 2008 and what it did, right? What it did. And for some reason, the memories are not there. I had a discussion with my business partner yesterday. We do a weekly webinar just to touch base with our investors. And we were talking about the difference between 2008 and today. And yeah, there is a lot of, underlying fundamentals that are different. But I honestly believe we're gonna see some similarities in certain markets as the foreclosure crisis begins to bleed into the marketplace. When the bank says, okay, this COVID crap is now kind of a little bit behind us, time to pay, right? You owe me money. And if they don't put it on the back end with the arrearage, then you're going to have a lot of Americans who are facing, pre-foreclosure challenges again. So who knows, right? I don't know what your take on it is, but I don't think it's going to be peaches and cream.
So I'm here in Las Vegas, and you would think because of the hospitality industry that we'd be like suffering, but people are moving here. It's like there's this relocation happening everywhere, and rents are rising, which is weird. Property, there's no inventory. And so at some point, you're right. At some point, there's that moment, that defining moment, that's something that I guess the word is when the shit hits the fan. Sure. And then all of a sudden, real estate's not sexy anymore. And then everybody's like frantic and just starts trying to sell and properties go down. I don't know what it's going to look like. We don't have crystal balls, but guys like us and that have experienced these downturns, because I was in a very similar situation in 2007. I was in my mid 20s, and it wasn't a fun experience to own a lot of real estate that went down by 60% of value. And I didn't have the same mindset, skill set I have now, that, hey, buy cash flowing assets, because even if rents decline, they're still gonna cash flow. And so I think, there's gonna be a rude awakening for some. I don't know what that's going to look like, and we'll find out. But I think it was smart of you to pivot. And why don't you tell me how, Freedom Venture Investments, how that fund started? And is it an actual fund? Or are you actually syndicating each deal, or is it actually a fund?
It's a fund. So we do both. Great questions, Beau. Before I answer that question, though, here's something that I do think is going to happen. And my partner, Walter, down in Fort Myers, brought this to the table yesterday. In 2008, Vegas, California, Arizona, Florida, brutalized, 76% reduction in values. And you just hit the nail on the head, as we say, because Vegas is attracting people, Arizona is attracting people, and Florida, 1,500 people a day statistically are moving to Florida right now. So when you look at that migration of people, no matter what comes down the pike, Walter's comment was this, and I think you'll agree with it. He said there are certain pockets in the US who are going to sit out the next correction. And I think, to your point, Vegas will be one of them. We're seeing it now, because if you go to New York, you haven't got an increase in rent valuations in New York City. You don't have it in Boston, where I am. You don't have it in San Francisco. So, you know, those other markets, I think, are going to be the ones that really take the hit. So that being said, pivot. When we went out of business with the hard money lending business in the beginning of COVID in March, I reconnected with Walter. I've known him for about 4 or 5 years. We were both in the education space, but we were the 50 and over crew. So Walter and I sat down and had intelligent conversations at the end of a day of coaching and training and mentoring these folks coming through. And I knew him to be a man of execution. He'd in the Florida market since 25 plus years down there, Gulf Coast region. Walter had raised about 125 million in private equity, deployed the capital, paid back the targeted double-digit returns. So it was a proven method. There was no, proof of concept needed. Okay, and we got Joran at the beginning of COVID, and he said, "Look, Dave," he said, "COVID is going to create a massive opportunity," and it almost was a crystal ball for us, because what he predicted was a massive migration to Florida and a massive opportunity in mom and pop operators who don't have reserves, right? Who have been working on a tight yield for so long. And as soon as they hit a bump in the road, it's like, holy shit, now what? Sell, run away, right? So no management, no ability to reposition either tenant base or structures. He said, we could do 1 or 2 of those. He said, we raise a fund. He said, why don't we put a 506c Reg D fund together? He said, we'll use your beautiful face and your international attraction as a star of A&E TV, flipping Boston. He said, we'll brand it out. He said, and we'll raise accredited investor capital. We only work with accredited investors. So we put together a fund, $100 million fund. The assets sit inside the fund, and then our investors, have prorated shares in the management company that manages the fund. We looked at the landscape was perfect. I mean, we're about 50% of where we want to be on the financial raise. The good news is we're paying quarterly distributions. So everything is firing exactly as we expected it to be. Would we have liked to have, capped out Fund 1 and been working on raising Fund 2? Yeah. But I learned one thing in my career, and I don't know if you learned the same thing. I sense you do, getting to know you. But, if you want to know how to do something, follow, ask, and or employ somebody who's already done it. It's called mentorship, right? So, I started talking to some guys who had, $2.5 billion under management. They've raised a lot of capital in their careers. And a lot of the mistakes that they made, I didn't have to make. And yet some of them you got to make yourself, right? So the fund is structured with 3 GPs, myself, Walter, the chief investment officer in Florida, and then Eric Wilson, who is the youth on our team, 26 years old, same age as your wife, 26 years old. And he brings all the skills that we don't have, man. I mean, I'm not good at automation and systematizing, and he's just phenomenal at it. He's really created a platform that our investors can consistently visit, look at all of their documents, their subdocs, the PPMs, et cetera. So he creates all of that automation and makes everything flow nicely. Walter is killing it on lead generation, both inbound. We just started some outbound marketing now. For some assets outside of our buy box for the fund. So let me the fund structure. So we buy B-class assets with core cash flow plus, meaning the ability to reposition, 50 to 150, 20 to 150 unit complexes, the smaller ones. And the reason is those mom and pops are hurting, and we're coming in and we're buying. We reposition them. We got the verticals in place for our property management. We got verticals in place for our construction teams. With over 25 years in that market, he gets the first phone call. So it's all off-market deals that we buy. We call them pocket listings in the industry, right? You're not going to find anything that we've bought on LoopNet. You're not going to find it on CoStar. You're not going to find it, in the local paper. You're not going to, it's all off-market stuff, which gives us and our investors, a pretty substantial edge. Return portfolio for our investors accredited. Minimum investment, 100 grand. Majority of our investment conversations around the 250 to 500 mark. 72-month hold, and then it's a 2 and 25 structure. So 2 points to the management company at the time of acquisition, and then a 75-25 equity split and cash flow split over their preferred rate of return of 6. So you get the first pref 6 is theirs, and then it goes into a 75-25 waterfall with us, targeting out their returns at 12 to 14, 10 to 14%, 10 to 12%. It's so hard because I know what the real projections look like, and if I put those out there, people go, "Oh, that's not possible. I'm not doing that." It's so far out of the norm. So we actually dial it back to around 10% targeted quarterly distributions, and then their internal rate of return, the value of their money working over the 72-month hold inside the fund, is the IRR targets out about 21-22%. And then the last metric that an investor wants is their equity multiple, and that comes in at 2.4. So for every $1 they put in, at the end of the investment, they get that $1 back plus another $1.40. So that's the way we structured it out.
So in year 3, are you looking to either sell or refinance? Is that the goal?
Yeah, so we have discretion inside the fund to sell any asset inside the fund if we think it's the right time to do so. We can make a larger distribution at the time of sale, or we can roll that into more acquisitions inside the fund. So 72 months is the end game, liquidation of everything inside the fund, and then outside of the fund, we might do core plus, which is a new classification that I created. It's not quite a value add. And it's not a core plus. It's kind of like in between. So what we'll do is we'll do those deals outside of the fund structure as one-off syndicated assets. So we've got, I'll tell you, we got one on deck right now. It's 81 doors in the Orlando marketplace. We're going to close that in a couple of weeks. That's a $7.5 million all-in acquisition and capex. That one's coming in at like a 12 to 14 on the cash on cash. 1.7 because it's got a shorter hold time of 3 years. And then the IRR is coming in at around 19, 20 on that. So
are you usually doing agency debt like Fannie or Freddie on acquisitions like that?
Great question. So we bring in 65% loan to value. Mm-hmm. Our first lien position relationship is with Walker Dunlop. Mm-hmm. They'll bring that capital to the table. The one I just said in Florida, for example, there's a lot of assumable loans out there right now, and they're still a pretty good, debt structure. And we're walking into one just under 4, I think it is. New debt, $1.5 million on this deal. That's at around 3. We were talking about this earlier. It's ridiculous. The cost of capital right now is ridiculous. And then our investors are bringing the mezz or the bridge in there. They're bringing in so it's a $3 million raise on this one. So there's so much opportunity. You just gotta. I was talking to an investment group yesterday, and they were telling us what they were looking for. And I said to them, so send over a letter of credit, send over your proof of funds letter, and we'll go. And there wasn't resistance, but you could see that. It's like I said, I'm a blue collar guy in a white collar world. I'm not going to dance around it, right? Give me a letter of credit, proof of letters. I'll go shopping. And I used the Bill Parcells line. I don't know if you're a football fan, but Bill Parcells said to Robert Kraft when he took over the Pats before Belichick came in, he said, the problem with Mr. Kraft is he wants me to buy the groceries, right? He wants me to go buy the groceries. But no, he wants me to cook the dinner, but he won't let me go buy the groceries. And that's why I said to these guys, I said, guys, if you want me to cook dinner, you need to give me the capital to go buy the groceries. I'll buy the groceries. You give me the money, and then I'll cook the dinner for you. and they started chuckling, you know what I mean? So, there's just, there's a lot of capital out there, man. There's a lot of dry powder sitting on the sidelines, a lot of, institutional capital looking for somewhere to go. I mean, that's your business, right? So, yeah, it's the right place, right time for sure.
Yeah, no, that's one thing I haven't done well in my life is I mean, on smaller, properties, I've used other people's money. But yeah, I definitely, talking to you and my other friend, Vinny, who's a big syndicator, it's like, it's really about bringing
Vinny Chopra?
Yeah. Vinny. We actually do a show on Friday. We do a show actually at 9:30 every Friday live. He's a character.
Yeah.
Yeah, I mean, he's, he started with one investor, right? Now he's got 200 and they keep on reinvesting with him because they're making great returns. And so I've learning from guys like you and Vinny and like the writings on the wall to do, right? Because there's a lot of people with capital, but
it's so good, man. Yeah. I've got a couple of relationships now with guys like Vinny, for example, right? And what we're able to do now is co-GP on some of these assets. Mm-hmm. So let's say you take a guy like Vinny and he says, hey, I got investors who are hungry for deals, but my deal flow is kind of tight right now. What do you have? So then they do. I just did it on a deal recently, a co-GP structure where the guy bought about $2 million to a deal. Then he comes in on a co-GP, gets a prorated position. It's still on the mezz side. So there's still a ton of upside in there. They underwrite the same way we do. They go through our due diligence packet. They tick their boxes and then they come in. And it's like, it's such a great way to do business because, as fund managers, syndicators, we bring a massive service. Think about this for a second, brother. We bring a massive service to the community because, for so long, average American, what was it? It was 401ks with the employer. And maybe if you had a couple of extra bucks, you give it to a financial planner. And that was it. Like the alternative investment space has been exclusively for the high net worth and the ultra wealthy for so many years. Well, that's changed. You don't have to go out and get 50 plus years of experience to be successful in commercial real estate. All you have to do is just hitch your wagon, baby. Hitch it on, come for the ride. We got all the bases covered. I make it simple, but you got to educate them and bring them up the gradient first. But that's a great service that we provide them. I don't have any reservations about that ever. It's just strong.
Right. Yeah. I mean, as a passive LP, your job is to find good operators, right? And find these good operators and keep, test them out. They do what they say, test them out again, right? And by 3 or 4 deals, you should have a pretty good comfort level with these operators. And because these doctors and these IT professionals making huge money, they need the deductions. Not only are they going to get the cash flow, equity, all that good stuff, they get their K1s, they can get paper losses. There's so many benefits, and they don't know that. Or they could have a retirement account that they don't realize that they can self-direct those funds and invest in things like your fund in different syndications. So, I mean, there's something like $26 trillion in retirement accounts right now. So it's not even tapped. It's maybe 2 or 3% tapped.
Yeah. Do you know that there's also 86 trillion, which is in a negative yield situation in the bond market right now? Did you know that?
I didn't know.
$86 trillion is in a negative yield scenario sitting in the bond market right now. JP Morgan pushed that out a couple of months ago, that data. Like, it amazes me how stupid people are, right? Hey, if I'm too direct, kiss my sunshine. You know what I mean? It is what it is. It's straight up stupidity. Money in a mattress, money in a bank, money in a savings account, money in 401ks that are underperforming. I was talking to a certified financial planner, and he was giving me the real inside scoop. He said the average investor, like the stock market returns, maybe 8%, we'll say. Yeah, if you put your money in there and leave it alone. But they don't, right? The knee-jerk reaction of the average investor, statistically, he said the average return is something like about 2.5%, 3%. So if that is in truth, and I don't know, I'm just telling you what the guy told me. I don't know the stock market. But if that is truth, what's inflation right now? Is it 3? Is it 3.5? We've got a little bit of additional debt that's come into the marketplace recently, just a couple of bucks, nothing too much. You know, what's that going to do for my kids and your kids when you have them, right? And the grandkids. So, you know, sitting in those negative yield environments and hoping that the bond market comes back because it's FDIC insured, stop it. You know, it's donkey mentality. You gotta get up. You gotta get off the couch, man, and ask some questions. You know, so I get a little aggressive with it.
No, it's good. I like the bluntness of it. So what do you do when you're not working? What do you do for fun?
Great questions. Look, I've got a 9-year-old and an 11-year-old. The 26-year-old is independent, so he doesn't take up my time. Look, man, I'm like most folks. You know, I like date night. You know, date night's fun. She has to arrange it all. I don't. You know, I just show up with a clean shirt on and a smile. And then with my little guys, they got some sports going on, and I like tropical fish. I'm a tropical fish freak. I like the fish tanks, and my ultimate is my it's an obsession. It's not healthy with high-end Lego sets. So I just finished a 10,000 piece Lego set of the Colosseum. Oh yeah, I'm crazy, dude. I'm not all there for sure. So, you know, I'm not wild and crazy. I'm sober 31 years, so I don't go out and tie one on. Those days are long gone, you know, but, you know, look, for me, financial independence wasn't, you know, cars, boats, and leather coats. You know, financial independence isn't a Ferrari. I know you're in Vegas, but, you know, the Vegas lifestyle just ain't my thing, yo. You know what I mean? I used to do a lot of business in Vegas, and they called me the ghost. Because at 8 o'clock, they turn around and D would be gone. And then all the idiots would go out and spend their time on the strip, and they'd all be shitty in the morning. I'd be like, hey, how you doing? Come on. Showtime. Let's go. You know?
I don't party at all anymore, but I do I live out in the suburbs. So actually the desert is really beautiful.
Sure.
Like believe it or not, when you get away from the strip.
Yeah.
But I do the mornings here. I get up really early. I'm up by usually 3:30 or 4 in the morning.
I'm up at 4.
I do my miracle morning. I work out.
Cool.
And do that and then get started. So I go to sleep early, but I wake up extremely early, and I'm very productive in the morning. And then I want to turn off earlier in the day. Now, where do you see Freedom Ventures going? What's your goals here for the next coming years?
Yeah, great questions. So we want to round out Fund 1, execute and deliver. We anticipate that at the end of Q3, beginning of Q4. The institutional partners that we're bringing to the table, you know, that's relationship driven, right? But once that relationship is solidified, you know, it's a different check writer altogether. It's a $50 million check writer. So having 2, 3, 4 of those partners on board, and actually I'm looking at the list that we went over this morning on our partners meeting. You know, there's 4 right there who could probably fund $1.5 billion, $2 billion. We can meet their yield requirements. So what I see for us on the horizon is expanding outside of the Florida market. We'll take down the Texas market next, work our way up to the Carolinas. We stay in business-friendly states. Won't be buying in New York City, guys. Don't ask me. Won't be buying in Massachusetts, Texas. Don't ask me. So we'll identify those markets. And then because of my network and skill sets, we'll open up our asset-based lending fund for the investor community. And then also the self-storage. So I've got a lot of self-storage connections that are looking for capital. And that's another place where you can get a nice consistent yield in the marketplace. So I picture, you know, Fund 3 being a couple of billion, and that'll be able to put some debt and equity into the marketplace as well as the hard assets.
Yeah, that's good. I like you know, there's such a need. There's a lot of bridge debt out there for bigger multifamily, but nobody's really cornered the like sub 2 million. I mean, and I think that's like, there's lots of deals out there, and there's nobody funding it. It's very difficult to find, you know, good bridge debt. So I like what you're doing.
Yeah. We got goals, man. We got goals.
Those are some good goals. I like that.
Yeah.
That's really good. All right. Well, we'd love to have you back on, and talk more in detail about some of your particular, your value add deals and walk through the nitty gritty and kind of learn more about how you underwrite and how you're finding these deals. And so we can get a little bit of knowledge. I think this was great to just get, find out more about
Big
you
picture.
and to meet such a celebrity as yourself has just been a true honor.
You're the celebrity, Beau, not me. You, man. You're the guy. You're in Vegas. Come on now.
You know what I get a lot? Actually, people go, are you know who I remind people of all the time, and I love it. They go, Vin Diesel. I go, okay.
Nice.
I go, yeah, because the voice is a little nasally, the bald
I used to get Mel Gibson back in the day. I don't know if I still got it.
I could
a
see
little
that.
Mel Gibson.
A little bit. That's not too bad. Too. He's a crazy guy, though.
Yeah. He liked a little of this. He had some opinions about certain races in our world that weren't politically. Some people are just dumb too. You know what I mean? Money and smart doesn't necessarily sit in the same basket. You know what I mean?
Yeah.
I got a philosophy that God, helps you out in one area and might hurt you in another. So if you're exceptional in one thing, you're going to suffer in another area. Just to keep the balance of life the right way out. But hey, Vin Diesel, it's been a pleasure, man. I can't wait to come back.
All right, thank you so much. Thank you so much. It's been a lot of fun. This is what I needed my Friday. Now
give Vinny a hug for me when you see him, will you?
I will. He's just always so excited.
Good stuff.
Thanks for listening to the Investor Financing Podcast. For show notes and useful resources, please visit investorfinancingpodcast.com. For questions or comments, email info@investorfinancingpodcast.com. If you enjoy our show, please share it with your network. Until next time.